Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Well, hello and welcome to Private Banking Strategies with Vance, Lowe, and Seth Hicks. Vance, how are you today?
Hey, I'm doing wonderful. Looking forward to our topic today.
Me too. Fantastic. We are talking about a smart risk framework for your private banking strategies. Smart risk framework includes how you apply wisdom in the systems and the strategies. We talked about what the purpose in the past few episodes of what smart risk is. And we talked about avoiding speculation and preventing emotional decisions and having models that capture downturns and worst case scenarios so that you can power through. And we talked about it in the context of real estate investment. We talked about long-term goals and safeguarding the family bank with these stewardship principles. So today I would like to drill down with you some on a very key and fundamental part of the smart risk framework, which is documentation and stewardship of your bank. Documentation of your capital sources coming in, capital deployments, your loans, and how your family bank stewards those loans. Let's start there.
Let's do, because it seems to be human nature to procrastinate and not have as much discipline as we need to have. And if we don't, we fall into trying to remember, forgetting, and not executing the way we need to. In Nelson Nash's book, he talks about a grocery store story. And all of our clients put themselves as the grocery store owner and understand how the flow of something works. In a lending business, you have to be able to have documentation. You have to create a loan. You have to be able to track it. You have to know at all times how much interest has been paid, how much principal has been paid, what the due date is, and document that. Just because it's our own or in a family environment doesn't mean you get to skip steps. But time and time again, when we've got a client coming in and needs a little bit of rescue, rehab, so to speak, we find that the attention to the details are not there. They're trying to skip steps. They're just not as attentive as they need to be. So every loan we have needs to be set up the proper way, as if we're out on the street and doing a loan for a regular client. Even though it's off the street, it's in a family, it's in your private environment or your private economy, you're required to be able to go through a loan process. If you don't, then it's going to fail. If we don't, then we're going to be, as Nelson says it in his grocery store story, we're going to be stilling the peas. So that's the whole emphasis that is driving us to have this conversation today, is to be able to come up to the plate and be able to meticulously know exactly where we are at all times on all loans for not only ourselves, but for everybody else. So what's that going to entail, Seth? What does that documentation look like?
Well, let's back up and talk about the grocery store example that Nelson Nash is used as a cornerstone example. You're a grocery store owner. You have all this inventory of products, beans and meats, and we talk about peas. So there's cans of peas, and you've got your stock inventory, and your family comes along, and because it's their grocery store, the wrong idea is to just load up your grocery store cart and go out the back, load your car up, and don't pay for anything. But Nelson rightly points out that the profit margin on the sale of a can of peas is much lower than one might think. And it actually takes the 17 more sales of cans of peas to make up for one that was stolen. So the taking or the stealing or not paying yourself back actually will implode your banking. Every transaction has to be documented. So loan agreements and promissory notes are standard in the family banking operation, such that there are repayment schedules that are kept. Just like if you went and borrowed money from the corner bank to purchase a car or purchase a house or purchase business or expand business, there's going to be repayment terms. You're going to be making monthly payments with a prescribed annual interest rate, and you're going to have an amortization schedule over a certain amount of years, depending on the type of loan, that you have to pay back. So the same documentation, the same procedures, the same strictness of repayment is required in your private banking strategies. You have to have the promissory notes, a repayment schedule, an interest rate that fits within your cash flow. And you have to make those things happen. And it's so simple now with modern day banking. You can literally set those things up online and they take place without you having to do anything after it's set up. So I think the next level that we kind of dig into is, well, how do I know what type of loan repayment to set up? And we talk about, well, if I'm the banker, don't I want 50% interest? And the answer to those questions are yes and yes, but how do you do it?
Yeah, let's delve into that. And let me back up one more step into practicality. Folks, what we do here is if we are practical in setting up and repaying our loans, if we're honest with ourselves, when we take it out of the back, we think we're getting an advantage. We take the groceries out the back, or if we give a client or ourselves a discount on a product, we think that there's an advantage to doing that. And there's not. If we pay full price, if we have our spouses load up their grocery cart and go out the cash register and take away all sales ads and discount coupons, and she ends up having to pay full price, there's a lot more profit on that, isn't there? And who gets that profit? The owners do. And whenever we do loans, the advantage of doing the loans, the practicality is we control the loan. If situations change, we can restructure the loan because we need to make sure the money comes back. What we can't do is spend the money and then forget about it and not make the payments, because that forces everything else to subsidize, that theft. That's what we're talking about here. It's not that, if I don't make the payment, I get away with it. You don't. It costs you more by not making the payment than it does making the payment. So
I think that's where people get hung up a lot of times, is they go, well, I hear you saying that, but I don't see how that really plays out with numbers. And so you have to actually sometimes play the numbers out. The first time that I read Nelson Nash's book, I'm thinking, you got to sell 17 cans a piece to make up for that 3% profit you were going to make on that one can. Like, how do you even stay in business? That doesn't make sense. But it does if you're a grocer. It does if you have inventory and cash flow and you understand the profit on each sell that you make. It does make sense. And the same thing with banking. It should be second nature, common sense, absolute like base level, that when you borrow money from a bank, you have to pay it back. And so this bank is no different. And it doesn't matter who owns it, whether it's you and your wife or you and your extended parents, it doesn't matter.
We have these false ideas because most of us refuse to follow correct money principles. And the one I think that we're talking about today that involves loans and stealing from ourselves is called the law of 10%. That's a kind of like a biblical law. The first thing we're supposed to do all the time is pay ourselves 10%, but we don't. We leave it till the end, or we'll either pay ourselves, and then when we get down to all of our expenses, we usually end up not having any more money because we paid ourselves the 10%, or we perceive that was the reason we don't. But yet we've got one more bill. And people throw their hands up in the air and say, hey, I've got to take this money and pay that bill. And they pass up the most lucrative opportunity for an investment you could ever think of. If you split yourself in two and say it's the person in the mirror who has the obligation to make the payments because they go to work, they earn a paycheck and come home and they spend the money, we're going to finance that for them. And same thing inside of Lowe. That payment represents money flowing back to us, and it means a second touch. And that's why it's so valuable. Let's say it's a $200 payment. It isn't about $200. It's about $200 every single month Or we take that $200 and we go buy more debt, and now we make $20. And we take that $20 and buy more debt, and now we make another $2. So we're not only making $200, we're making another $20, and we're making another $2. And we miss out on that when we miss that one payment. That's what we're talking about. It isn't about the one payment. And when it comes to product or anything like that, the cascading effect is, we've got to raise prices on cans of peas or whatever else to cover the theft. And it doesn't end there. It becomes a habit. That's where discipline comes in. If the grocery store owner takes the food out the back, do you think the employees won't try to sneak some out the back? The store fails. When the loan process is not repaid properly, the interest mounts up. So we have to have a schedule. We have to go in every single month and decide whether that payment is made. If the payment's not made, we have to enter that honestly as zero. Or if it was a smaller amount, we put the amount that was paid and the loan is recalculated, and it will shock you at the end of the loan how much that missed payment is going to cost you. We go through that in our training and setting up and running our lending company with the software. How one payment, I don't know, for me, I show an example on my home, $1,100 payment, and I missed one after a couple of years of making payments, and I put zeros in there. I did that twice in a row because cash flow was bad, and then had the money to make it up. But I used it as a training example. I let them see at the end of the loan, those two $1,100 payments were $67,000 balloon payment at the end of a note in a mortgage. Don't ever not make up a past payment on a mortgage. Your mortgage company will go, okay, we've charged you enough penalties, just keep making the normal payment. And they're just smiling because of how much you got to come up with when you sell that house or at the end of the loan. So following these procedures, Seth, being able to have the schedules, know where you're at all the time, and be disciplined to be able to do that are critical.
Let's take it into the family context where you have a matriarch and a patriarch that have made generation one policies on themselves, and they've got policies on their 3 children, and they've got policies on their 6 grandchildren, and they are in their 70s. And so son 1 wants to start a new business. Son 2 already started a restaurant that's successful, and he's making cash flow payments back to the family bank that fit within what he projected. And the 3rd is a daughter, and she's not using any of it right now because she doesn't have a need or a purpose. But the first brother gets into a bad investment, isn't able to make the payments back, and that creates a big, big load on the private family bank because someone has to pay for that money that was lent out to the son that couldn't make a go of an investment, couldn't make a go of a business, didn't find a job after he got out of his expensive 4-year college education. Whatever the case may be, that creates a drag on the entire family banking system. And so if one sibling is stealing the peas and going out the back door with the peas and the beans from the grocery store, the rest of the family has to absorb that and take on that debt. And so one of the things that we have to work out among multi-generational 100-year family bank folks is what happens when someone fails? What happens when they're not paying back? And those are hard decisions that need to be made up front when you've got an extended family, because the rules have to be in place for everyone to know where the lines are. And you can't allow one son or one daughter to steal the peas or not pay the loan back that they borrowed from the family bank. So those are structured protocols. Sometimes those are done in various forms of documentation, different structures. Sometimes people have trusts. Some people have different entities. It depends on what they do and who they are and what their skill sets are.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
But how does a family report to one another? How do they periodically check in? Do you have any framework or guidelines for folks on that? Like, how often should we review loans?
The rule of thumb that seems to be very successful is that all loans are reviewed every 90 days, quarterly, if everything's normal. The second a payment goes beyond the late period and it's missed, then you're all over on that loan to try to figure out why. Was it forgotten? Was it set up in bill pay but didn't actually get there? Is something happening? Has the earnings changed? Are the funds there to be paid or not? The faster you get on a loan that misses its first payment, the easier it is to steer the ship to correct and minimize the loss. So we need to find out the reason. One of the biggest reasons is people being laid off at work. They have a system set up, they feel absolutely secure, everything's fine, and through some fault, not of their own, they no longer have the income to make that payment. This is where the family bank can come in and help shield that, because since the loan is controlled, it can be refinanced. That loan payments can be postponed for 6 months. That doesn't mean the interest doesn't start. It keeps going every single month, and that will mount up in the loan, and that person will be responsible for that payment. But it could be totally restructured and drawn out and have a much lower payment to meet the needs of a person. If it's an accident, it can be postponed until they get back on their feet. Resources could be located, found, or whatever else. What are the options? So you start that. You don't wait for several months. You start that process early. That introduces what's called collateral. What type of loan should a family bank be doing, and what can they absorb is the criteria that we should consider. If we're going to do a used car loan, we shouldn't be doing car loans on new vehicles because of the depreciation. Our banks are not large enough to absorb the depreciation if that car immediately goes out and gets in an accident or it defaults. There's no collateral there to assure that loan will be paid off. If we finance or if we purchase existing loans, say in the back half of the loan period process, on a 5-year loan, if we pick up a loan 2.5 years or less, that is very profitable. There is equity in the car. That car itself could be sold and that loan could be paid off if it had to be that, if it's the fault of the borrower. If they caused being terminated, for instance, they got into drugs or, they just mouthed off or something, they got lazy and decided to quit and thinking they can, make the family bank pay because they're mad at the family. The car would be immediately repossessed before the second payment is ready if it's determined that that can't be made up.
So regular review of outstanding loans and making sure cash flow is on time and in place. And we've talked about a family bank. The gentleman since passed, but he had 2 older daughters that as he began to expand his policies, and they had over 100 life insurance policies, none of which were on him because he was uninsurable, but on family members and business partners, that the capitalization of their bank became so large that they simply began making hard money loans and third party private loans. And that's all these 2 siblings did, was run the bank, underwrite banking, document banking, enforce compliance, and then taking back collateral if necessary. And so they basically became private money lenders through their own family bank. We're talking about small potatoes, so to speak, in some of our examples, but that particular operation, they were lending tens of millions of dollars. And so there was secured transactions, collateral. If they're making real estate loans, they will foreclose and take the property back.
What's funny, the people you're talking about was one of the people that trained me. He started off as a farmer's agent. And this was occurring 25 years into the plan. They were into the hundreds of millions of dollars, not hundreds of millions, I mean the millions of dollars out in loans, hundreds of thousands in payments coming in every month. And it took these 2, they worked at it full time. They had third-party loans. He owned interest in one of the major hotels on Las Vegas Strip, and lent to dentists and chiropractors, and he had a collection squad he used to tease about. If they wouldn't make their payments, he would have Guido go visit them. And it's all part of a policy and procedure because you can't not get your money back. The bank fails if you do that. You've got to always know that that money's coming back and take steps to make that happen.
So it's important when you're running your initial structures and you're making loans to your children or to your grandchildren that they understand the stewardship expectations, that this is an arm's length contractual arrangement and agreement. And just because their blood relationship doesn't change the terms of the bank. That's what secures everybody. That's what secures the children and the grandchildren. And the greater whole is you don't bend rules for one person. And you've talked about, well, okay, we analyzed various life situations. There's ability to modify the loans and create a different repayment schedule whereby they're still participating. And it's effectively a loan modification. And that's not defaulting, and that's not poor stewardship. That's actually good fiscal stewardship, and it shows the effort. And not every sibling will borrow or repay with the same amounts.
Right. It's the incentive of a private family bank. If we want an incentive, yes, we'll take advantage of the incentive. It's because everybody cares about it. It's family. Family works with family. If it's, an unforeseeable situation, we can restructure a loan if we need to, where on the outside, they'll laugh at you. Oh, you had gotten in a car accident? Well, you still have one good leg. Can't you go back to work? Because we're not going to change the payment. You default, we take the car. Where in a family bank, we can work with that. We can figure out a loan to keep the money working and know that it's going to come back in eventually. That's what we care about. We care that the money is working. The volume of return is what it's called. The payments are always coming back. And so, yes, that all has to be reported. All that has to be up in a family council if there is a loan and it's set up. And definitely something can't happen, then there are consequences. The benefits also are, hey, you finish paying off your loan, you make earn equity in the family bank. A portion of that interest earned in the bank can be ownership for you as you're working up the ladder. So there's all kind of great ties by participating and fulfilling the obligations inside of a family bank. It makes the bank very prosperous, and we all share in that prosperity.
And that's why we've talked about, I describe it as following the lines that are on the road. You know where to drive, you know where to stop, you know what the speed limits are. That's called stewardship. You have the accountability and the transparency. Everybody knows what they're dealing with, and everybody knows what they have access to. And the reality of it, some siblings might say, well, I'm the firstborn and I get this. It's my inheritance and this is mine, and have entitlement mentalities sometimes. And look, you're going to be in a foxhole with somebody before this life is over. Whether you choose to go into business, and you're going to have alliances and people that are in your foxhole and people that aren't in your foxhole. And I have found that it's better to have your own family and blood in your foxhole than others. And so this creates a system for family and blood relationship to create something that most people don't have in our country, that most people are living paycheck to paycheck. They're beholden to the third-party banks, and he who holds the gold makes the rules. So they have to go and beg Wells Fargo and Bank of America for money. We're talking about a system that's outside of that worldly system. It's your own family banking system. And it allows you and empowers you to do the same things that you can do anywhere else in the world, except without the strings and without lying prostrate before Wells Fargo, begging them for money.
And it's all about having money working for you instead of money working for someone else, and you're trying to get an interest rate and you're taking all the risk. In a family bank, your money is working for you. You're making the profits, you're making the interest and the earnings. So do it right. Treat this as the best, most lucrative asset it really is. There's nothing better than it, in the world. There's nothing more lucrative than a lending company that's profitable.
And that's why we have to have smart risk framework, and we have to have the things that we've talked about in the past few episodes that protect the decision-making process for the family. Everybody knows the rules. Everybody knows that there's stewardship and expectations for repayment. It ensures that your capital in the family bank is deployed in smart frameworks. We're not blowing money on speculative things. We're not blowing money on emotional, I got to have this. We're not blowing money on things that just depreciate right when they roll off the lot, like a brand, Ferrari. And that protects the entire system. So there is an element of the greater good. You don't get to make your own rules because you're the firstborn son or because you're the favored daughter. The rules apply to everyone in the family banking system, and whoever sets the family bank up dictates that. That's what people come into. When families use the smart risk framework, they apply these principles, the capital becomes like a fortress. It's a fortress that can provide strong and safe capital when it's needed. People don't realize what a value that is. Having dry powder ready.
And Nelson nails it in his book. It's the golden rule. He who has the gold makes the rules. And it's the power behind the family. It's the solvency. It's the feeling of well-being, of security. And it is a fortress. The way it's set up can't be breached. They can't come in and rob your bank, so to speak, because, the money's in very, very safe hands and where it should be in these contracts. So that's why we do this. That's the whole purpose of the paperwork and the procedures, structure, and the discipline for following this. People, please do that. Don't cut corners because you're only hurting yourself.
That's right. Yeah, folks, if you like what we're talking about and you want to learn more, go to our website at privatebankingstrategies.com. It's privatebankingstrategies.com. And there you'll get an option to sign up for our weekly emails. And we will announce our podcasts that are upcoming, and we'll continue to teach you on how to create and operate a family bank. But you'll also have the opportunity to read through a book that Vance and I published that is called Secrets the Banks Don't Want You to Know. And that book is something that will red pill you to various issues in the banking industry and provide great value in understanding how to get outside of traditional lending lanes and begin to start your own private bank. But even more importantly than that, you're going to have, through those emails, access to Vance's calendar, which only come through those emails. And you can schedule an exploratory call with Vance. Tell folks what the exploratory call is.
What we try to do is get people prepared to actually take the strategy, the whole banking strategy, for a test drive. We use your numbers and then we show you simply. We get you ready, we get your mind, what we call in the ballpark. So you're asking questions that pertain to the strategy and you can see the difference right off the bat. You'll know in our presentation meeting by the end of it, hey, I want in or I want out. It's just like a test drive with a car. You know if you want that car or you don't. So that's what we try to do. We offer that to everybody. That's on us. And we hope everyone that hears this and thinks that the strategy might work for them, do yourself an advantage and take some time and take a look at it. At least read our book, because I think that'll introduce the concept.
Absolutely. Well, folks, thanks for joining us on this podcast, and we look forward to having you back on the next one, and we'll see you then.
Thanks very much.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.